In this example, we'll look at how we might use a simulation to decide on inventory policy. So please pause the video and take a moment to read the problem. Okay, the Butler distributes home ventilation fans. They order the fans from the manufacturer at the cost of $75 per unit, and then they turn around and sell them to the retailers for the price of $125 per unit. So that means the gross profit they realize is a difference between 125 and 75, which gives us $50 per unit. The monthly demand for the fan, let's call it D, is described by a normal distribution. So that is from month to month, the demand is not known. It's going to vary from month to month, but it could be modeled by a normal distribution. And the mean demand for the month is 100 units. The standard deviation is 20 units. So the Butler places an order for the fans at the end of every month and then receive the order at the beginning of the next month. Now, as a company policy, they want to have the same number of units, the same inventory level at the beginning of each month. So this beginning inventory level is referred to as a replenishment level, or we'll call it Q for short. This means the units to order depends on how many fans are left in the inventory. So how does this work? Well, let's suppose Q is 100. And at the end of the month, there are 10 units left over. Then when you place an order, you would order 100 minus 10. So the order quantity will be 90 units. On the other hand, if there are no fans left over at the end of the month, then you would just order 100 units. The common problem in inventory management is that it's hard to know what the customer demand will be. You have really no control over how many customers we want to buy the next month before you make the decision of how many to have available. So if you have more than what the customers want, then you're going to end up with inventory at the end of the period. And carrying inventory costs money, like the capital costs, storage costs, insurance, tax costs, and so forth. As it says here, for each unit of inventory, it costs $15 of the holding costs. For instance, let's say Q is 100 and the demand is only 90, then 90 is less than 100, so then there's 10 left over. So inventory left over is 10, and the holding cost for that month will be $15 per unit times 10, so $150. On the other hand, you might have too little. Maybe the customer demand might be higher than you expect, and then you're going to run out. You experience a stock out and have to turn away customers, in which case you lose a sale and the customer might go somewhere else to buy these fans. There's a cost involved, and here we are given there's a shortage cost of $30 for each unit of demand that's not satisfied. So again, for instance, let's say demand is now 110, whereas Q is still 100, then the shortage will be 10 units, and there will be shortage cost of $30 for each one, so it's $30 times 10, and $300 of shortage costs will be incurred. The idea is to pick a good number for the replenishment level so that the total net profit will be the highest possible, accounting for both the holding costs and the shortage costs. So here's what we would like to do. We want to determine the replenishment level that will give the highest monthly net profit while satisfying at least 95% of the customer demand. Specifically, there are three things we're going to do. First, for replenishment level of, let's say, 100, Q equal to 100, we will do a simulation to determine the average monthly net profit. So we're going to do the simulation for 100 months and get the average profit from that. And we'll also compute the service level. That is a percent of the total demand that will be satisfied. Now the goal is to find the optimal Q. So what we need to do is not just try one value of Q, but try lots of values of Q to see which one gives us the highest average monthly net profit. And we'll have to make sure that it meets the service level requirement of at least 95%. Now let's figure out how to calculate that monthly net profit. As we know, profit is revenues minus the costs. So let's see where the revenues and the costs are. Here it says gross profit of $50 for each fan sold. So there is a gross profit that basically represents the net revenue. So it's $50 times the number of units sold. That's money coming in, so that's a plus. And let's call this just a sales for short. Remembering that by sales, we mean the number of units sold, not the dollar amount. Now there are two kinds of costs mentioned, inventory holding cost and the shortage cost. So there's a holding cost of $15 per unit times the inventory level, and that is a cost, so that should be subtracted. Now the shortage cost, here we have $30 per unit times the units short or shortage, and that should be subtracted. So the profit must be the combination of these three terms. So now we just need to figure out the units sold, inventory, and the shortage in terms of the demand and the replenishment level. Let's think about how to get these three terms, sales, inventory, and shortage, in two different cases, when the demand is less than Q and when the demand is greater than Q. First, let's think about the case when demand is less than Q. So to make it concrete, let's put in some numbers as our example. Let's say Q is 100 and D is 90. In this case, what is the sales? Well, sales is how many you end up selling. Like if you had 100 but customers want only 90, how many would you sell? Well, 90. You can't force them to buy more than they want. So sales will be 90 or the demand. Now what is the inventory? You know, the leftover amount. Well, you sold 90 out of 100, so there will be 10 left. So 100 minus 90 is 10, or it'll be Q minus D. Now what about the shortage? Well, if you have some units already left over, then by definition I would say there is no shortage. So shortage will be equal to 0. On the other hand, what if demand is higher than Q? Then, for instance, demand is 110 and Q is 100. Then how many do you end up selling? Well, you can't really sell more than what you have, so the sales will just be 100. That is equal to Q. Now the inventory is 0 because the demand exceeds what you have, so there will be nothing left over. Now here, you are short 10 units because customers only 110, you had only 100. So shortage is difference between these two numbers, 10, or the formula would be D minus Q. You could see that the formulas for sales, inventory, and shortage are different depending on the two cases. One way you could deal with this is by using an if function in Excel. Like here you might say, when D is less than Q, sales is D, and if not, the sales is Q. So you might write it like this. Sales is equal to if, here's a condition, D is less than Q, then it is D, and if not, it is Q. Remember, you have condition first, and then the value if the condition is true, followed by the value if the condition is false. Or if you notice that in each case, the sales is a smaller amount between D and Q. Like here, the smaller number, D, and here, the smaller number, Q. So that's because you can't sell more than what the customers want, and you can't sell more than what you have. So it's a smaller amount between what the customers want and what you have. So we could use a simpler expression using the min function, min d comma q, and that would be equivalent to using the if statement. Now the inventory we could write as q minus sales. That is what you had minus what you sold. You could check that in the two cases. So here, sales is same as the demand, so it's q minus, well, that we could replace with sales. Now in the second case, sales is q, so if you plug in q here, q minus q, well, you get inventory of 0. So that makes sense. Q is what you had at the beginning. Sales is what you happen to get rid of. So what's left over, that's the inventory. In a similar way, we could write shortage is equal to D minus sales. D is what the customers wanted, and sales was the demand you were able to satisfy. That is what you were able to provide. And if there is a difference, that is a shortage. Again, let's check this in both cases. Here the sales is a demand. So if I plug in D here for the sales, I get D minus D. Well, that's equal to 0. In this case, the sales is Q. So if I plug in Q here, I get D minus Q, which is what we got. That gives us this net profit formula. Gross unit profit, like $50, times the sales, minus unit holding cost, 15 times inventory, and minus unit shortage cost, that's $30 times shortage. And the formulas for the individual components are given here. And the sales is min between D and Q, as we saw here. Inventory is Q minus sales. From here, shortage is D minus sales from there. As an illustration, in the first case, with using these numbers, profit would be 50 times sales is 90, minus 15 times inventory is 10, and minus 30 times shortage of 0 will give us 4,500, minus 150 minus 0 is 4,350. As another illustration, in the second case, profit will be 50 times 100 for sales, minus 15 times 0 for inventory, and minus 30 times shortage of 10 gives us 5,000, minus 0, minus 300, with a 4,700 for the answer. I'd like to clarify one thing about calculation of profit functions. You might recall that in the risk analysis example, we had a profit function that looked like this. Selling price minus variable cost, and multiply all that by demand. Now you might say, well, what about the sales? There's a difference between demand and sales usually, but in a strategic decision like deciding whether to manufacture a certain product, that is a part of a broad planning. We don't worry about all the details like the difference between the demand and the sales. But the inventory planning is more of an operational kind of decision, and we do need to distinguish between the sales and the demand. Basically, the idea is that the units sold may not be exactly the units demanded. And also we need to recognize that the selling price is attached to the number of units sold, and the variable cost is attached to the number of units produced.